as far as what's in that set of audited statements, and you usually see something that's, 8 to 10 pages long, and there's all these numbers. There's really 4 statements that you'll see, and probably at least 3 of them. It's the statement of financial position, a statement of operations, a statement of changes in net assets, and a statement of cash flow. The first 2 you will always see. The third one, the statement of changes in net assets, right now, organizations, you will always see that. The statement of cash flows, you may or may not see that in certain financial statements. Up until now, it's been optional. But moving forward, you will always see the statement in cash flows. And we'll talk about cash flows as we go through this. But I want to start with a statement of financial position, because this is the one that people probably, no one ever asks any questions about it. People really don't understand what it is, and it just sort of is almost passed over. But it is an important statement, and what you probably have heard of is the balance sheet. People talk about the balance sheet. When you see an audited set of statements, you'll see the term statement of financial position. And what it represents is the total assets, liabilities, and equity of the organization at a point in time. And that's really important, that it's not a statement for the 12 months ending or 6 months ending. It's a snapshot of the organization at a particular date. So if your year end is March 31st, it's the balance sheet as at March 31st, 2009 or 2010, or December 31st, whatever your year end date is. So that's very important. So it's valid for that day only. So April 2nd, your balance sheet could look completely different. So there's different sections of the statement of financial position, the balance sheet, and assets. And most of you probably have heard the term assets. And just in simple terms, it's basically what the charity owns or is owed from other people. And you'll see 2 sections on assets, current assets and long-term assets. So you'll see a section that'll say current assets, and those are the assets that are expected to be converted to cash or used in a year or less. So the types of things that are current assets are cash, short-term investments, inventory, prepaid expenses. Those are all things that are considered current assets. And then you have long-term assets, and you'll see that. Usually what you'll see is current assets, you'll see a subtotal, and underneath that you'll see what are called the long-term assets. And those are the things that will be converted to cash or used in more than 1 year. Things like investments. So if an organization has an endowment income, you'll see the line investments, because that's intended to be there for, in perpetuity, or certainly a number of years. All those big ticket items like a building, land, equipment, all of those things which the term fixed assets you may have heard about, those are things which are considered long-term assets. And this is an example, just an example of what you might see on a statement of financial position. And you can see that there's always 2 years. So you have the current year and the previous year. And you'll see this, the current assets, usually there's more lines than in your long-term assets. So here you see cash and cash equivalents, accounts receivable, inventory, you've got your subtotal, then you've got investments, capital assets, and a line for total assets. So that's a simple balance sheet. And the format of balance sheets changes from organization to organization as far as how much detail you might have. There might be other categories that might be collapsed in only 1 or 2 lines, but that's some of the common line items that you would see in terms on the assets section of the statement of financial position. So I want to go through each one of those lines. Cash and cash equivalents. I think it's important to remember it's not necessarily the bank balance in the operating account, because cash and cash equivalents includes all of the bank accounts and any short-term investments. I think when a lot of people look at cash on a balance sheet, they assume that that's how much cash is in the bank that day. And remember, when you get your audited statements, it's probably 3 to 6 months after they were done. So your financial statements at March 31st, 2009, you probably aren't seeing them until sometime in the summer, might even be early fall. And so when you get that number on that report doesn't represent the cash in the bank that day. For one, you're getting it in June. Lots of things happen in the first 3 months of the year. And then secondly, there's other things that are included in cash. So when I look at a balance sheet, when you look at cash, one of the questions you might want to ask is, what's included in cash? Just so that you understand what cash really is for the organization. And more importantly, why is it increasing and decreasing from the previous year? And for most of these lines, that's the type of thing you want to look at. Is it going up? Is it going down? And why? And just on that point, if it's going down, if the cash balance is going down, it doesn't necessarily indicate a problem. It may indicate that there might be cash flow problems. It may not be a problem at all. And that's why you actually want to ask the question as to why things are increasing or decreasing. There are reasons for that, and we'll kind of get into that a bit later. The second line item that I showed you was accounts receivable, and those are amounts owed to the charity from third parties. And this would be things like government contracts. Say you get money from the government, and you have to put in a claim form before you actually get the cash. So at the end of the year, March, you perform the service, you send out an invoice, they might pay you hopefully within a month, or it could be a couple of months, depending on the government department. That money that's owed is set up as an accounts receivable. It's money owed to you, you just don't have it in the bank. The other thing would be fee-for-service contracts. If you actually sell goods, you've actually have kind of some kind of retail operation, and you're owed money from clients, those types of things will be set up as accounts receivable. Money owing to the organization for services delivered. So when I see accounts receivable, lots of questions I would ask. One, what's included in accounts receivable? So if there's a big number, if there was $1 million in accounts receivable, I would want to know why. Secondly, I wanted to know, has the money come in, or when's it expected to be paid? Because if I see the financial statements, say it's June, the year end was March 31st, so it's June, I would have expected that money to come in by now. 3 months later, the money should have come in. So that's one of the questions I would ask. If I see a lot of money in there, first thing is, have we received the money? And if not, why? Has it been outstanding for a long period of time? Is there anything that you think is going to have to be written off? Because that's a problem. You've recognized the revenue, you set up this accounts receivable, are you really going to get it? And again, why is there an increase or decrease from the previous year, if it's significant? So those are the types of questions that you want to ask around accounts receivable. Next category, prepaid expenses. So prepaid expenses are expenses paid in the current fiscal year that will be utilized in the next fiscal year. And two common ones are things like insurance. So when you pay for your insurance, you usually pay for an entire year. Again, I'll use a March 31st example. If you pay for your insurance in January, it's for the calendar year, January to December, at March 31st, you've paid everything for the entire year, but at March 31st, you only want to recognize 1 quarter of that money. So if it was, let's put a number, easy number, if it was $40,000, $30,000 of that insurance bill that you paid is for the next fiscal year. So you'd set that up as prepaid expenses. So expenses paid for things will be utilized next year. Rent would be the other one. Like very often you have to put first and last month's rent. Last month's rent, that's prepaid expenses. Some organizations where they're renting a lot of property, you might even see prepaid rent as a line item. But very often it's just everything is grouped together as prepaid expenses. Again, you want to know what are the prepaid expenses? Is it insurance? Is it rent? And once you get into those questions, once you get answers to those questions, then you'll want to get more information, and that's where you really find out what's going on in the organization. So if they say that there's a lot of money in prepaid rent, then maybe you're thinking, wow, there's a lot of money in prepaid rent. Like, how many spaces are we leasing? Like this type of thing. You'll start to have more questions. And normally when I present financial statements to people, if there's any significant variances, I want to give some commentary, some narrative to that. I never just present numbers without having some explanation to it. So if you're in the position where you're presenting financial information, you should try and anticipate the types of questions that people will ask and have the answers for them ready. But if you're just receiving a set of financial statements and, you don't know the organization, and very often people ask, I want to see a set of the financial statements. It seems to be almost like commonplace. You have to give your financial statements, but sometimes I wonder what people actually do with them. Do people read them? So now, I'm hopefully at the end of this, you'll actually be able to look at them and ask some questions. The capital assets, and this is now, we've finished with the current assets. We're now into these long-term assets, capital assets, land, building, equipment. I put this down, what's the market value, if there's a building owned, what's the market value of the building? Because on the audited statements, the building will be recorded at a cost value, not the market value. And I use this example, where I work, for example, our building was donated to us. So if you looked at our audited financial statements, it would be a very small amount for the building. But it is in no way reflects the value of the building. So sometimes looking at the financial statements doesn't give you all the information. You would have to ask questions about that, particularly if there's a building involved, and if it doesn't make sense, then ask the question. So you want to make sure that you know what's the market value of the building, and then are the assets insured? Like, does the organization have insurance? And you would assume that people do have insurance over their assets, and it's something that they would have, but sometimes, and I've seen cases in smaller organizations where they may not have thought about insurance, may not have thought it's necessary. So it's a good question to ask. Does the organization have liability insurance? And are their assets insured? And again, and with every one of these, you'll see the same question. Why are things increasing or decreasing from the previous year? So if it's increasing a lot, have there been purchases, and what are the purchases for? Investments, and this is the last thing on the asset side. So investments, these are the things that are planned to be held longer for 1 year. And for a foundation, for example, foundations will have an endowment fund. So that's an example of maybe a long-term investment. The other time where you might see this is if the organization has what's called a reserve fund. So they might not be an endowment fund per se, but an organization will set aside money. Say you make a bit of a surplus at the end of the year, the board may decide to set aside some money specifically in a reserve fund. It's not going to be used in the next year. It's used in cases of an emergency, or say if the funding was cut off completely, you'd have this reserve fund. It could be intended to be held for a long period of time, and that could show up under investments. So, a question would be, what are those investments? What are those investments set up for? And now investments are recorded at market value. In the past, investments were recorded at cost value, so you really would want to know what are the investments really worth. Now when you see financial statements, you're actually seeing the market value, but again, the market value at the year-end date, not the market value today. So if you see his statements, and if it's March 31st, and you see here's what the investments are worth March 31st, if it's now June 30th, the investments could be very different. Anytime I see something like investments, I would ask, what's the value of those investments today? And you just want to know if there's any additions or subtractions from the investments. So that's basically the asset side. So the main categories that you're likely to see, some of the questions you might want to ask around that when you see those lines. So let's go to liabilities. So that's the top half of that statement, and the bottom half is liabilities. So liabilities are amounts that the organization owes to others. So again, there's short-term and long-term liabilities. Short-term, those that are payable within a year, and the long-term that you'll pay in more than a year. Here's an example of what the bottom of the liability section might look for, and it's liabilities and net assets. We're going to concentrate on liabilities here. Current liabilities, I've got two categories that we'll talk about, and then obligation under capital leases, and that would be a long-term liability, because usually if you have a capital lease, it might be for 5 years. A common example would be a photocopier, where you're leasing it over a number of years. So it shows up as a liability, money owed, but it's it'll be paid over more than 1 year. So let's go through these. Accounts payable, accrued liabilities. What are they? So, amounts owed to vendor not paid at the end of the fiscal period. The common thing that will happen is you purchase something, I'll keep using this March 31st. You purchase something March 30th, you receive the goods, but the invoice doesn't come in until April, and sometimes it might come in a week, 10 days later. So at the end of March 31st, you want to record that you actually spent this, that you've actually purchased it, there's a commitment, you have the goods, but you haven't paid for it. So it's money owed to the supplier, and you're just waiting for the invoice for it. So very often when auditors come in, and one of the things they're looking for is anything that that needs to be accrued at the end of the year. They spend a lot of time looking at that. And one of the things they spend a lot of time looking at is everything that's paid after March 31st. So they'll go through and they want to see everything that we paid from April 1st to the time they're there to see if any of those things that we paid for were actually items relating to something prior to March 31st. So that's recorded in the proper year. So if you see accrued payables, and you'll see that line, and if it's a large number, then you might want to ask, what is it? What is it that's being owed, and to whom? And is it increasing or decreasing? And there could be many reasons why it's increasing. So if your accrued liabilities and payables are increasing, it doesn't necessarily mean that it's a problem. There could be a good reason for that, new contracts or whatever. You just want to know why. Hopefully you're okay here. Deferred revenue. So this is a big item on the statement of financial position. And so it's also known as deferred contributions, revenue received in advance. Those three terms: deferred revenue, deferred contribution, revenue received in advance. So it's money received, deposited in the current year for services to be delivered in a future fiscal period. Biggest common example would be a government contract. So you get a new contract, they give you an advance. So maybe it's going to start in April, but they'll give you an advance for the first 3 months. So you get a check at the end of April or end of March, you deposit it, but the project doesn't actually start till April. So at the end of March, that's considered deferred revenue. And that's what you'll see in the liabilities section of your statement of financial position. And so that's really important because that can be a significant number, and you definitely want to know, if I saw that number, who did the money come from? What program is it for? When will the money be spent? And is that number increasing or decreasing? Like, you want to look at that and ask why. What is it that's causing it to increase or decrease? Capital leases, I talked about this a minute ago. This is amounts owed on leased capital items. Photocopier is probably the most common one. Most people are leasing their photocopiers. It's usually like a 5-year lease, something like that. So that money that's owed, it's obviously for more than 1 year. So the portion that you owe that's like from years 2 to 5, that's a long-term liability. If I see anything under capital leases for an organization, I just want to know what's being leased. Could be a photocopier. Sometimes if you see that there's computers being leased, and you might question, well, computers aren't that expensive. Why are we leasing it? Is that really should we really be leasing that? Would it be better to purchase it rather than to lease it? So that's one of the questions I would ask. You want to know what it is they're leasing. When's the lease complete? Like, how long is that commitment for? And again, has there been any increases or decreases? Any additional items leased? I think it's one of the key things is, when is the lease complete? And this could be for rent as well. If you have a commitment, like a 5-year commitment on office space, and you want to think about that in terms of contracts you may have, particularly in a smaller organization. If you have a government contract for 2 years, but you're leasing something for 5 years, so you've got funding for 2 years, what happens in years 3, 4, and 5? So you may be on the hook for a lease, but you don't have any money to cover it. So you need to be aware of that type of thing, and I think your board needs to be aware of that something's coming up. There is some risk here in having some of these long-term leases, going for a longer-term lease if you don't have funding to cover that. And you have to be aware of that risk. I'm not saying you shouldn't do it, or you should only go for a 2-year lease. And sometimes you do have to go for a longer lease, but you just need to be aware of what the risk is. How much is out there in the future that you don't really know how you're going to fund it. So the bottom section, and this is probably the section that people would find the most confusing, net assets. But actually the calculation it's actually quite simple, because net assets, it's what's left after you subtract the liabilities from the assets. Like, it's a simple calculation. But what you'll see is, very often, what you'll probably see is 3 categories at the bottom: invested in capital assets, internally restricted, and unrestricted. I'll go through these a bit, but for most readers of statements, I think what you really want to look at is that bottom total to see whether net assets are increasing or decreasing. If the organization has a surplus for the year, then your net assets are going to increase. If you have a deficit, they're going to decrease. That's really the key thing to look at first, is that number increasing or decreasing. Again, here's an example of what you might see. As far as the different sections, internally restricted and unrestricted, essentially what happens with net assets in a very simple situation, if you took an organization from the very beginning, say at the end of the first year they'll have a surplus of $1,000. $1,000 is what might be the net asset number, and it would be an accumulation of the surpluses and deficits over time. In simple terms, that's what net assets will be. But then they get split out into different things, and the board can decide to take those net assets and restrict them for certain things. I mentioned before about a reserve fund. Some organizations will set up a reserve fund, so put money aside as a contingency in case, like a rainy day fund, and they'll set that from the net assets. So say you have some surpluses for 5 years running, and you build up a bit of money. So what they might decide to do is, let's put that money aside. You might even invest it separately, not even have it in your operating account. Take that money out, invest it in whatever, bonds, or it might be another bank account, whatever, and it's restricted, internally restricted by the board. So that's generally where that internally restricted comes from. It's restricted by the board. The board has made a decision to restrict this money for certain purposes. And usually, it can't be used unless the board, there's a vote by the board, it needs to be approved. And then there may be some unrestricted money, which you have more flexibility in how you can use it. So maybe the board may decide 1 year, the organization may run a deficit, and that may happen. They may decide, okay, we can run a deficit because we have this money, and the unrestricted can be used to cover a deficit for a year, which would be very different from something that's restricted for a certain purpose. For example, some boards, if you have a building, and I'll use my organization as an example, we have a reserve fund specifically for the building because it's a heritage building. There's going to be a lot of work at some point. If something were to happen, we have money set aside for the maintenance and upkeep of the building over time. And so that money, we've had some money, and so we were able to split it away from everything else and basically put it aside. So that's internally restricted by the board. The section invested in capital assets, and I really just want to say, don't worry about it. It is probably the most difficult thing to explain to board members. I would say it's too complicated that I wouldn't want to go into how you calculate it here, but basically it's taking things that are related to capital assets, money that's used to purchase or lease capital assets, and it's everything around capital assets is sort of separated out from the total. I'm just going to say here, don't worry about it. I don't think it's worth spending a lot of time trying to understand the calculation for invested in capital assets. If you're really interested, there's notes in the financial statements about it, but in terms of looking at an organization and trying to figure out, are things going well or not, I wouldn't call that a priority area to look at. So now I want to go to the statement of operations, which is the one that people look at first, and you get a set of financial statements. Everybody wants to look at the income statement. So that's the statement of operations, income statement, profit and loss statement. And this probably people are familiar with, shows the amount of revenue that was earned over the period of time, the amount of expenses that were incurred over the same period of time, and then you have a difference, which is the surplus or excess revenue over expenses. There's different terms for it, but I think that part is pretty straightforward. Here's an example of what a statement of operations might look like. And every organization will decide how much detail they're going to have in their particular statement. This one, it has government revenue split out by federal, provincial, municipal. Some organizations might just have a line, government revenue. Sometimes organizations will have the different departments on where the government revenue comes from, and that will depend on the nature of the organization. And then the other one you have, after that you have corporate and foundations, individual special events, all the private sector fundraising. And again, the level of detail there will vary depending on the organization. And whether it's a fundraising organization or an organization that's actually operating programs. Investment income, and then you might have something called other. And then below that, obviously your expenses, and for most organizations, salaries and benefits are, that's the major one. You'll always see that line. How much detail you have on the other expenditures, that's going to vary because every organization spends their money differently. So any of the big items you're likely to see there, but you can see some of the examples: program expenses, building occupancy, amortization, depreciation. We just talked about that. Fundraising expenses. Here's legal, audit, taxes, equipment, office supplies. So again, that varies. Travel might be one. Travel might be a line item in some organizations. So that's just a sample of what one might look like. They could be very different from that. So revenue. When I look at revenue on a statement, yes, you're going to look at what's increasing and decreasing. Also looking at the different categories of revenue and if they're increasing and decreasing and why. How diversified is the funding? So for an organization which gets a lot of their money from a government source, you want, what's the percentage of money that's coming from government as opposed to the money that's coming from non-government or private sector? So that's one thing you can calculate right away. And look at how that's changing from year to year. If you're getting government funding as well, is it coming from one department or do you have various departments giving you funding? Because you're more vulnerable. So if there's a change in government or if you lose your funding, and if 80% of your funding is coming from one ministry, if that goes, then what happens to your organization? You're more at risk than if you have, say, 40% of your money coming from one ministry and you've got some other money from another ministry and you've got some private sector funding, you've got maybe got some fee for service. So how diversified is the revenue of the organization? So generally, if you're more diversified, you would think that you're just a bit more stable. You're more at risk if you only have one funder for all of your operations. And sometimes, but that's very often the case, where the money is coming from one ministry of the government or one level of the government. The other question I asked about in terms of government, how long is the contract? Are the contracts in place and when do they end? Because sometimes you'll get contracts which are they're ongoing. You get them every year. And if you see a big spike in government revenue, the one thing that I ask is that a one-time grant that's it's a one-time thing, or is that something that we're going to have is it a 3-year commitment, a 5-year commitment? Exactly what that is for. So how secure is your revenue? When I'm doing budgeting, I budget out not just 1 year, but 3 years, because I want to know, here's the revenue we're going to have for 2010. What's it going to look like for 2011 and 12? What's in place? So when I look at financial statements for an organization, you sort of think about where the money's coming from and what's the likelihood that that government funding is going to continue over the next 2-3 years. And those are questions that I would ask. And some of these calculations as far as percentages, those are things you can do yourself. If you just got a set of statements, no other information, if no one was there, one of the things you can start with is just trying to calculate some of those percentages just to see, where the organization gets their money from. And then later on, if you're face to face with someone, you can actually ask the question, ask more detailed questions about it. So you actually understand what's going on in the organization. And then you understand where the risks are in the organization. So again, there's the example of revenue. You see something like investment income going down. And normally you might say, so why would revenue be going down? But sometimes that makes sense. Just given the markets, you wouldn't expect to earn as much investment revenue. So some things do make sense. But then if investment revenue, if it went from 120 to say $250,000, then you'd really wonder, given what was going on in the markets, how did we make so much more money in investments? And that's a question that you would definitely want to ask. And this could be like, I'm looking at the audited statements. This type of statement of operations, this is something you get throughout the year. I know that many organizations, the balance sheet isn't something may not be something that's presented on a monthly basis. It might be quarterly, and sometimes it's only done at the end of the year. People don't pay attention to the balance sheet as much as they probably should. People do. You always get a statement of operations. This is something that you probably should be getting every month. And so there's the type of questions that you can be asking on a regular basis and not waiting till the end of the year to ask the questions. Just as when a budget is presented to you. That's the other time you see something in this format, when a budget is presented to be approved. Those are the types of questions you should be asking about revenue. What's in place, what's confirmed, where are the risks? The expenses, as I said, the organization, you determine how much detail. Salaries and benefits is usually the largest portion of the total expenses. Very often 60% or more of total expenses. Okay, things that I would ask for. Overall, are things going up or down? That's fine. Are they going, if you look at the percentage that things are increasing or decreasing. So if your revenue is increasing 5%, how much are your expenses increasing? Are they increasing 5%? If they're increasing by 7%, you have a problem. So you never want to see your expenses increasing at a greater rate than your revenue, because then if that continues, it's going to be a problem. And if you do see that, and that's something, again, that you can calculate, then you want to ask the question, why? Why are the expenses increasing so much more? And there could be a reason for it. Maybe there's some, I don't know, you have to lease some space, or there's some kind of one-time expenses for the year, or you're investing in marketing and promotion for some reason. And so if that one particular year, there's a spike in the expenses. But if it's an ongoing expenditure increase greater than revenue, that would indicate there's going to be a problem. Staffing being the big one, and I usually ask, that's when you want to spend a lot of time on and ask questions about, how many staff are in the organization, how many are full-time and part-time, how many are on contract, how many are seasonal. So if you have funding for the next 2 years, the staff you have, are they permanent staff? Are they on contract? So when the funding ends, then their contract ends and you don't have any more obligations to these people? Those are the types of things you need to look at and you need to think about in terms of where is there a risk? Where are there potential problems? Might not be today, but a year from now, 2 years from now. Things on building occupancy as far as renting space. How much are you paying in rent? We talked about it before. How long is the lease? And how is that in terms of the contract? Are we leasing space, for 5 years? Do we have the funding to pay for that? Amortization, that's related to the capital assets. And anything around the capital assets and amortization, there's notes in the financial statements that give you a lot more detail about that. Special events, obviously there might be a lot of questions around how much is spent on fundraising. So you could be asking, and we'll look at something on ratios in a minute, but that's something you do want to pay attention to. Look at where your fundraising revenue is going. Is it going up or down? And looking at your fundraising expenses. So if your revenue is going up in fundraising, how much is it costing you to, earn an extra, whatever it is, dollar. Some of the other ones, probably more straightforward as far as, legal, audit, taxes, insurance, equipment, office supplies. I think it's the other ones. It's the big items on the expense side that you really want to pay attention to: salaries and benefits, building occupancy, program expenses, to really understand what's going on in the organization. What you probably, when you look at statements, internal statements during the year, some people only book that depreciation amortization at the end of the year. So during the year, when you're looking at financial statements, you may actually not see that line. So it might not be something that your program people or people in your organization see on a regular basis. So they're not aware of the whole depreciation amortization because they're not in control of that expense line. There's nothing that they can really do you can't decrease it by doing anything. Once you've purchased something, you have to amortize it. It's going to be amortized. There's going to be depreciation. So very often you won't see it on an internal statement. It'll be booked at the end of the year. And people say for myself, people in our field that are running programs, they don't see that. Okay, couple of ratios. There's a lot of ratios that are used in the for-profit sector, but I think there's a couple in terms of the charitable sector that are probably more useful and more common. The current ratio, and this is a calculation, current assets divided by current liabilities. And I took the numbers from the balance sheet that you had the example here. Basically, if you're looking at current assets, so that's all the things that will be converted to cash in a year, over the current liabilities, which is all the things that you're going to have to pay for within a year, you want that number to be over 1. So the problem would be, if that number was 0.85, that would indicate a potential problem, because what you'd be saying is you've got, say, $2.5 million in liabilities that have to be paid out in a year, and you've only got, $2.2 million in cash. How are you going to pay for your expenses? So calculating that very quickly would indicate if there is a problem. And you're probably, for most organizations, aren't going to see a big number. You're not going to see 2 or 2.2 or 2.5, something like that. Because most of your funding, if it comes from the government, you've got to spend that money. So you don't have a lot of extra cash. You're not making a lot of profit on government contracts. If you're funded solely by the government, you're not going to have a lot of extra cash lying around. I talked before about the deferred revenue, and I think this is important. If you have a lot of deferred revenue, say you had $1 million in deferred revenue, I would expect to see $1 million or so in your cash short-term investments, because that deferred revenue, remember what that is. It's money that was paid, for example, by the government for a contract for the next year. So if you've got $1 million sitting in deferred revenue, when you get that money, it should be sitting in your bank account. You shouldn't be using it for other purposes. So if I saw $1 million in deferred revenue, and I looked at cash and cash equivalents, and only saw $300,000, I'm going to think, well, what happened to all the money that came in for this project to run next year? You got $1 million, you set it aside because you said it's going to be spent in the next year, but you look at the cash and there's only $300,000. What happened to that other $700,000? And that might indicate that money is being spent inappropriately. There should be some correlation between your deferred revenue and your cash, unless it was put into some kind of long-term investment, which again is a problem, because if it's going to be spent in the next year, why you shouldn't be putting it into the stock market, obviously. But I mean, you probably won't see that, but if you were to see that, that's definitely something you would say, there's a problem here. Something's wrong, or if it's on an internal statement, then I'd question, are things being recorded properly? Like the audited statement during the year, you know that the auditors have seen it. You can kind of know that these are the numbers, they're the real numbers. During the year, if you do see a balance sheet, and if you do see an income statement, you can look at some of the other things. It may be that things aren't being recorded properly. So it is good to look at this thing, not just at the end of the year, but throughout the year, because you can sort of pick up on mistakes or problems before it becomes a real huge problem, before it's almost too late to fix it. So that's one of the ratios. And the other one, and probably a lot of you heard about this, is the cost per dollar raised in the fundraising field. It's a huge issue. There is no standard, and people don't want to share this information. People have different ways of what you include in terms of fundraising expenses. So I used this example. In the example that we had in the income statement, there was special event revenue and there were special event expenses. So just taking those two things, that one area of fundraising. So in 2009, $55,000 was spent on special events, raised $500,000, so 11 cents per dollar raised. If we look at the previous year, $475,000 in revenue, spent $50,000, so it's 10 cents per dollar raised. So when you look at that, you'd think, okay, we spent an extra $5,000 to get an extra $25,000. So that's when you want, and if that number was bigger, if it was 10 cents and it went up to 20 cents, you're thinking, we're spending a lot more money and not getting much in return for it. So you want to look at what's happening with those ratios over time. I think that's the most important thing. I know people have different things that they include in fundraising expenses. So for example, in special event, that's probably just the expenses to run the event. It's not the staff time. And every special event has a lot of staff time, and it's probably not included in the total costs of the event. But fine, if you didn't want to use that, that's fine. What you can do is look at, okay, if you decide all you're going to use is the actual cost of the event itself, at least you can look at that year to year. Be consistent. Whatever you choose, be consistent, because there really isn't a standard out there. It's not that everybody is putting in salaries into their special event expenses, and how do you do that? What portion of a person's salary is going into an event? And it gets very complicated. So I think what's, at this point, in my mind, and for our organization, is let's decide what it is we want to include in expenses and be consistent over time, because at least you can look at the ratios and see what's happening over time if you're consistent. Doesn't matter what the actual numbers are, let's be consistent. But that's something that you can do, and I think that's something that you should be doing, because there's a lot of, obviously there's a lot of talk about that in the media. People are always talking about what's being spent on fundraising as opposed to, what's happening, how much money is raised. So those are really the only two ratios I wanted to talk about. There's lots of different ratios out there. I think those are two key ones that you can use. A statement of changes in net assets. We talked about that before. That provides more detail than's on the balance sheet. So here's an example of what you might see. It's a separate statement. It's after the statement of operations. Has those same categories: invested in capital assets, internally restricted, restricted, and gives your balance at the beginning of the year, balance at the end of the year, and the second line, deficiency of revenue over expenses, is basically the net income or net loss of the year, and it's allocated out between things related to the capital assets and everything else. As you've heard, you may not have to get into all of this in your next year's statement, so I wouldn't worry about this too much, trying to understand it. And there actually are more detailed notes in the statements if you really are interested in it. I think what you do want to know is, does the organization have a reserve fund that's restricted by the board? Has the board set up a reserve fund? Is there a contingency there? Because as an organization, you would like to have a reserve fund in case the rainy day, if something happens and your funding is gone, it is prudent to have a reserve fund. So I think that's the question, that's really the question to ask, rather than how did you come up with the number for capital assets. And then statement of cash flows. And again, at this point, not every organization has a statement of cash flows in their statements, but next year you will see this with every organization, and shows some cash flowing in and out of the organization during the year. So here's an example of what a statement of cash flows might look like. I think with cash flow, and I think this is an important, it's very important to understand Is the organization managing its cash? Because when you're doing, even as you're going through the budget process, I think what people do forget is, what about the cash flow budget as well? So this statement shows basically over the year what happened. One of the questions I would ask is, what does your cash flow look like for the year? And so an example of what I've seen is an organization gets a government contract, that's great. They have all the money to pay for the program, but the way the funding works is the money's paid once you send in a claim form. But it could take about 45 days before you actually get the money. So end of April, okay, we get our statements the first week, we do the claim form, we send it in. It's almost the 15th before the government gets the claim form, then they have to process it. By the time you get your check, it could be near the end of May before you get a check. In the meantime, you have to pay your staff. Expenses are going out. So over the course of when you do your budget, it looks great. You know, we've got a balanced budget, and we might even have a small surplus, no problems. 2 months in the year, you have a cash flow problem because you don't have enough cash to pay your staff. And that's what a lot of people forget about is you need to make sure you have the cash when you need it. And so doing cash flow budgets, I think, is just as important as doing your operational budget. And I know a lot of people forget about doing a cash flow budget. And when they find out, it's almost like, oh, now what do? We don't have enough money. Well, maybe we won't pay those bills right away. We got to wait for a check to come in, and people start scrambling. So that type of thing, and if you're involved in an organization or if you're on a board of an organization, asking for a cash flow statement, asking to see that on a regular basis, what's the cash flow look like for the rest of the year? That's, to me, is very critical. And it's something that, just in my experience in different organizations, that's something that's forgotten. So those are basically the statements. I wanted to show you an overview of them. And then finally, the other thing in the statements, you'll see those 4 statements. There's notes to the financial statements that give you details, more detailed information on some of the specific lines. Where you'll always have notes, fixed assets will have notes, investments will have notes, deferred revenue will have notes. And you'll know there's a note because there'll be a number beside that in the statements. You'll see numbers in various places. That refers to the notes. So you can go back to the notes and get more information there. So if you're going through a set of statements and you're looking at a particular line and you have some questions, the first thing I would do is go to the notes. See what you can find out from there. As I said with the revenue, things like that, you can do a few calculations yourself, seeing percent increases and decreases. If it's a small increase, if it's not material, don't worry about it. It's things that are material that you really want to worry about. And then from there, then you have a set of questions that you can ask. So if you're in a meeting and you're presented with statements, and then you can ask them intelligent questions about the financial statements, which I think right now, a lot of people go into meetings and they have statements and it's like, well, I don't want to ask any questions because I don't want to look stupid, when people shouldn't feel that way. I think it's very unfortunate when people feel they can't ask questions about the statements. You should be asking questions about the statements. And so that's why I hope what we've been doing here, at least you have some sense, some of the things you should be looking at, some of the questions you could ask, and some of the areas that might indicate there's a problem, may not be a problem, but you need to know that it isn't a problem, that the organization has thought about it. If you're presented with statements, hopefully a lot of this has been presented to you. If I were presenting audited statements or any kind of financial report, I would never just give a set of numbers and just say, here you go. There would be a narrative with it to explain variances and to explain all of this. So that's the other thing I would recommend. If you're in a position where you're providing financial information, give people answers to the questions before they come back to you. You know what questions people are going to ask. You can go through it yourself. If you were new to the organization, knew nothing about it, what questions would you ask? And then answer those questions and have the answers for them.